You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune, yes, it is a funky tune. I like it. It's always got us bopping here in the studio. That funky tune means it's time once again for TWIFO. This Week in Futures Options, the program here on the old network where we break down exactly as it says the week that was in the world of futures options. Vol, skew, volume, open interest, big trades, all that fun stuff, hot products, winners and losers, you name it. We got you covered here on TWIFO. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever exciting, at least we hope so, Options Insider Radio Network. If you like TWIFO, first off, thanks. We love you. And if wherever you're listening, if you are listening on iTunes and others, if you are so inclined, if you like it, head on over to give us a review. We do like that stuff. And if you're ready to upgrade to the full kit and caboodle, the whole network, the other 14 shows, and wherever you are in your platform of choice, could be your iTunes, Stitcher, wherever you get it, then just head on over and grab our full network feed. That includes TWIFO and every other show on our network. So Option Block and our daily options news rundown and volatility views and advisors option, all that fun stuff. So if you want a veritable slew of options content, and then we got you covered. And of course, nice little bonus for you hardcores out there. We stream it live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern. Buy a mixer. Gonna get some hardcores today because we know it's a holiday weekend. A lot of you heading out early for the weekend, so we appreciate you guys who can join us live and see how the sausage is made. And of course, however you listen live after the fact, hit us up. Questions, comments, insights, pearls of wisdom. We love all that stuff. You guys know how to find us. And I do mean us because I am joined once again on the old Twifo program by my cohort, my partner in crime, the man of endless enthusiasm, none other than Mr. Nick Howard, the founder of Bantix Technologies and the creator of a little platform we like to use around here called Quick Strike. Mr. Nick, welcome back to the show. And on a 1 to 10, how excited are you this week for Twifo?
Well, I don't think there's really a scale to measure my excitement right now.
I'd say at least 14. At least 14, right?
Yeah, or the other way. One way or the other. I'm not going to tell you.
-6. Now I'm nervous.
I'm not telling you either way.
All right. Well, with Nick's excitement in question, we'll see if we can jazz him up, listeners. Let's get into what product do you think, Mr. Nick, should we kick it off with this week? If there's one that's top of mind for everybody, what do you think everyone's really looking at?
Well, I think I know what people usually want to see. I have some items I want to cover myself, but we can. I know that the coin flip's probably going to go over to Crude, but we need to talk about Crude and then gold too. It had a good little activity. RBOB did as well, but they didn't have much in terms of option stuff. So let's go with Crude. Let's go with Crude and discuss what I believe is just nothing that I expected after this week. So yeah, let's go there.
A weird week. That might be the headline. If we were to tweet about it right now, which we probably are, I would say perhaps not what we expected in crude options this week. Hashtag what happened? But yeah, it was a crazy week. We were talking on the show last week, of course, about the impending hurricane over there. What would happen? How would it impact things? Of course, with a week in the rearview mirror, we know exactly how Hurricane Harvey impacted things, and particularly for that Houston area, it was quite devastating. A lot of flooding still continuing in that area. So, of course, our thoughts out to everybody in that area who listens to the show. And a lot of commodity people down there. Hopefully, you guys are probably dealing with bigger fish right now than listening to the show. Don't worry, we don't blame you. You can catch it after the fact once everything is sorted out. But it did have an impact on our refining capacity. That's what everyone was looking for. Of course, the Gulf rigs were all shut down ahead of it, and now, of course, over there in Texas, a lot of large refineries there also out of commission. In fact, somewhere around 20% of U.S. refining capacity currently offline as a result of the hurricane. So that is a big impact. We did see some other moves to kind of countervail that a little bit. We saw them opening up about 500,000 gallons from the strategic oil reserve. It's not a ton, but it's enough to at least maybe to dampen fears, get a few good headlines out there that we are doing that sort of thing. But, Nick, I think you're right. We were all of us expecting, if the hurricane was as devastating as it turned out to be, if it did have as much of an impact on the refining capacity as it appears to have done, we all thought crude would be a heck of a lot north of where it is today, probably somewhere north of the 50 handle. And yet here we are exactly a week later, looking back at the week that was, and where is crude? It's pretty much unched from where it was last week in the front portions of the curve, slightly lower in the back portions of the curve, a little bit higher, but pretty much unched from where it was last week or right around there. There were some turbulent moments there during the week, but pretty much, yeah, you're right. It wasn't really what a lot of people expected. People were expecting big volume, big volatility, big movements, big bang. And that's not exactly what we saw. Volume-wise, it was a decent week, but nothing really to write home about. Open interest net on the week only up about 3.5% or so. So we've seen stronger weeks on other smaller reports than this. So kind of interesting there. Vol also pretty much off net on the week, which again, is probably another surprise to people. Again, some of that was the event risk, people pumping it up for the event and then maybe inevitably coming off. But the fact that the event has been so protracted, you thought maybe the vol would continue apace for a little bit. But no, vol net coming off on the week too, depending on where you're looking. Kind of slightly unched middle of the curve, a little bit aggressive towards the front portion of the curve and similar towards the end there. So interesting stuff, a lot of interesting stuff here across the board. If you're looking at, it said, hey, Mark, what was the number one hot strike out there in crude this week. The number one strike du jour, number one with a bullet out there this week. What's the strike we say a lot? We talk about a lot. The one people watch a lot. The one a lot of people thought maybe crude would be higher than at the end of this week. It's the 50 strike, and that is exactly what we saw out there. Was the OC 50s lighting it up yet again this week. Number one, and not surprisingly, the lion's share of that volume coming earlier in the week on Monday. It was about 28,000, 28.5 or so. Almost 11,000 of that coming on Monday. Earlier in the week is when we really saw a lot of hurricane-related activity. Kind of evened out throughout the rest of the week. Again, and the open interest only slightly opening net on the week, so a lot of back and forth churn on that 50 strike, which isn't really unheard of when you see these kinds of events. Everyone was kind of speculating, is it going to get north of there? Oh, it's not going to make it. Oh, maybe it is. Oh, no, it's not. And so as a result, we saw a lot of back and forth on that strike. Coming in number two, kind of neck and neck with each other, we saw the 48 calls, so a little bit more optimistic, I should say a little less optimistic, a little more realistic out there with about 22,000, and those were the lion's share, actually coming on Tuesday, about 8,000, so a little more than the third coming just on Tuesday. And again, slightly opening on the week, but nothing enormous to write home about. Followed hot on its heels by the 45 puts. So again, that 50-45 strangle, risk reversal, call it what you will, was pretty active, taking the number one and number three spots respectively. 20,000 and change of those OC 45 puts, lighting it up this week. 6,000 of them coming in on Monday and about 5,400 coming on Thursday, actually. The rest of the week coming in much less. And again, slightly closing net on the week. So there's a lot of back and forth action on both strikes. Maybe people coming in early in the week to kind of speculate what they thought was going to happen, and then closing out later in the week once they realized it wasn't materializing, because it certainly was perhaps a bit of a surprising week for a lot of people out there. The weeklies not exactly lighting it up again this week, with small numbers going out there at 49 calls, probably in the front week, probably the most active with 300 and change. But that's really not an enormous number. You get out there to November, you see the 55 calls, the double calls doing pretty decent numbers, all just shy of 10,000 out there this week. Pretty even throughout the week. Tuesday, though, the largest chunk of those. Get a little bit farther out again. Get all the way out to June of next year. It was the 45 puts with about 5,000 of those leading the charge out there. Most of those opening this week, so maybe some long-term pessimists coming in, maybe some put writers out there as well. And you get a little bit longer term. Wasn't a lot of funky paper way out there. You look at DESA 2018, double calls again, where the strike du jour out there, about 4,000 or so of those kind of lighting it up. In terms of, maybe one of the weirder strikes, it was a small trade, about 300 of the 35 puts for DESA 2020 lighting it up this week. So a long-term pessimist making himself known perhaps out there. But weird stuff, Nick, I think you and I both have called it weird because it wasn't really what we expected. It wasn't the rock'em sock'em robots. It wasn't the heavy turbulence. Did you see anything maybe in the quick skew land that could have maybe affirmed what you expected, or was it pretty much the same deal out there?
No, I think that's the part that was really interesting because, again, I don't know much about the fundamentals in terms of how it's supposed to get affected by, by the hurricane or by supply issues and stuff like that. But I just would have imagined that this would upset production. It doesn't necessarily change supply, but you can't replenish the supply. So you thought you see a little uptick. Now you saw the gasoline part of the energy that got quite a bump from a percentage standpoint. In particular, yesterday, I think was the biggest jump we had. But I just wasn't sure. I guess you don't lose capacity if you don't. I mean, you don't lose supply if you don't pump it. You're just not pumping for that period of time. So you have sort of a temporary shift in numbers. But that's the thing. I really didn't see the price action higher, and everybody kept talking about it, and I kept watching. I'm like, I don't see anything. I'm not seeing it. The only place you really there were other commodities, which we'll talk about in a little bit, but I didn't see anything that was that supported any of the talk that they were, other than when the RBOB contract, right, and that was purely present future standpoint, and not really anything to do with volatility. Didn't do much at all. So so from that standpoint, I was, and again, you don't ever want anything so horrible to happen in this country or anywhere for that matter. But, if that doesn't affect volatility, what does, right? Because when you look, we saw a knee-jerk reaction to when they had the whole nuclear talk with North Korea and Trump spouting back, his pointless words, and then it comes right back again. You see this just devastating disaster. I'm wondering if this is something that until the impact's really known, we won't necessarily see that. And I've seen that before in the markets where you kind of the reaction you expect to get during the event doesn't necessarily happen. But then once they see the devastation on the ground, right now, if we see that there's some of these, storage tanks that they're terminally breached or anything like that, then maybe we see it. So I don't necessarily think you put the upside of this market to bed. I just surprised that we didn't see the initial event activity or increase in futures that I thought we would. And as far as volatility goes, we were down on the week on all the short dated stuff, which that's coming out. The event risk is coming out, but in general, it's kind of a non-issue. And far as skew goes, nothing changed in terms of the shape of the curves at all. So you didn't even see a bump in any sort of teenies above or even anything above the 50 strike. You mentioned the volumes. There was some 55 calls and stuff like that traded out a little bit in November, but not a tremendous amount to really impact the curve. So I don't know. What do you think? What have you heard? I mean, you see the headlines that talked about, I just saw stuff on Twitter. I saw the headlines and none of the market stuff really satisfied any of those headlines as far as I was concerned.
Yeah, I was surprised when I started seeing these headlines coming out that 20% of U.S. refining capacity off the table right now. I just assumed there would be a commensurate spike in crude, there'd be a commensurate spike in vol, and we didn't really see that. You're right, it wasn't certainly anywhere near to the extent that we might have expected, given the fact that that whole area was pretty much out of commission for the better part of a week and maybe for the foreseeable future. Yeah, but it was certainly not the extent that we saw at all. So that maybe that again kind of feeds back into the notion a lot of people have been saying for a while that it's going to be hard for crude to really get sustainably north of that 50 handle. I mean, I think what did Matt say about 52? That seemed to be a pretty good level for a ceiling out there, and even 50 is a challenge for crude to sustain. And if this can't do it, if this massive natural disaster that effectively shuts down a wide swath, because how often we heard about U.S. production, this shut down a whole swath of U.S. production, and even that wasn't enough to really move the needle. I don't know if it was the reserves kicking in. The numbers shouldn't have been enough to do it. Maybe it was just the calming effect of opening the spigot of the reserves. Maybe that had the intended effect. Whatever it was, it really seemed to tampen down the reaction to this in a way. I thought for sure when we came on the show today, it would be, we'd be talking all crude, all the action, all the movement, all the changes in skew, all the big vol. And we just didn't see that, Nick. It was kind of surprising.
Yeah, for sure. And if I go take a look at the RBOB, right, because that's the end product that we purchase, for the most part, we did see some short-term increases in the call skew there, right? So we saw a big jump in how rich how we could still look at the front-dated option, the October option in the RBOB that's got 25 days to expiration, and you did see a pretty good tilt in the curve. So puts got much cheaper, calls got much more bid. But outside of that, outside of the 60-day range there, or in the November contract where it's 55 days, nothing. So you did see a little. So there, I would say, and that market had the biggest upside from a future standpoint, right? We saw like a 12% increase yesterday, whatever it was, and then however much more we got, on the other days during the week, but the big one was yesterday, and it's still up for the week, as you can see on the reports. But yeah, other than that, nothing. That one reacted, and again, I don't know much about the whole. I know enough to kind of get in trouble a little bit with the show, but I don't know much about the steps to the process and what gets affected most. But maybe we can get somebody on one day that can talk about why we saw the reaction where we did. Maybe Eric Norland will come on again after things settle down in Texas, and we can pick his brain as to why the market reacted the way they did. But the only place you saw any kind of skew jump was in the short dated, what started out as a 30-day contract. So we'll see a big spike in the 30-day constant maturity for the RBOB, but after that, not much else in the energy sector.
We kind of already answered it, but I'll just I'll bump up this question from LLOC. No point waiting until the end of the feedback for this. He wants to know, hey, what's up with quick skew in crude? with Harvey. We pretty much just answered it. Not a heck of a lot. Were there any little nuggets that caught your eye, Nick? Any weird nuances you want to share with LL06?
Now, let me take one more close look here, but I'm really I've been watching it all week just because I was waiting because we were just kind of anticipating. I guess really no. I mean, nothing changed. If you look basically a whole year's worth of contracts, more or less, you got no change in the skew, and anything. And if we look at sort of the 50 days in November and October, we have a smile basically. So it's still anybody's guess about which direction we're going to go. Well, you have calls. I'm sorry, you don't have you have puts, bid, and calls offer a little bit in the November contract, and it gets progressively more tilted as you go out. But yeah, nothing of merit from a shape change standpoint, right? So again, we'll have to watch. I think maybe we watch in the coming weeks and see if that shifts, right? When if there's water covering everything, maybe you can't see the damage or can't see the problems you're going to have, or maybe that's when you start to realize things aren't going to come online as quickly as they anticipated, that kind of stuff. So yeah, so nothing really from my standpoint of merit to discuss.
Well, where there was some stuff of merit to discuss, let's turn our attention to the shiny stuff, to gold. It feels like an old school episode, Nick. Crude and gold. That's what people wanted when we first started, and they still want it this week, at least with gold doing the big dance this week. How long we've been talking? Oh, when will it break that resistance level? When will it break north of that ever mythical, magical 1,300 level? Well, it did so this week. It did so in style. Gold ending up the week up about 2.5%, about 13.25, 13.30, depending on where you're looking out there on the old curve. But aggressive move to the upside, kind of what the gold bugs have been hoping for some time after a protracted downturn in the metals, showing some nice and aggressive signs of life out here in all things crude. And of course the vol, interesting mixed bag. We've talked about gold a lot out here when it comes to skew. I'll let Nick get more into it in a second. He is the keeper of all the quick skew numbers, but it has been interesting to watch. Gold kind of a bit of an inverse product. Kind of why when we had Mike Tusaw on last week, he talked about how he likes collars in the metals so much, because you do get a lot of that juice for the call, which is not something you get in a lot of equity and index options. The calls are usually kind of lifeless. But in products like gold, where the bugs bid it up, and other metals, you get a decent premium for that call. So you can put on collars for decent levels, and sometimes even credits, depending on how you structure them. And so that's attractive. A lot of people out there who want to own the underlying, they want to own the asset, still have some protection, and are willing to part with a little bit of upside. They don't mind doing the occasional roll every now and then. It's merited for them based on the premium they're getting out there. And this week, certainly the upside move, certainly warranted. And we have seen, again, a lot of that steep slope to the call skew out there in gold. For a while, people have been trying to hope that this would happen, this would materialize. People didn't want to give up the ghost, and this week it finally happened. If you're asking us now, hey, with this big move past 1,300, what was the big trade? What was the big to-do, the big hot option for the week? And if you were going to say front month, maybe 1,300s, I would get what you were feeling. Maybe even 1,325s, I would get what you were throwing down. But no, it was the Dees 1,400. So everyone's already moved past 1,300. We're up to 1,400 now. That wouldn't surprise me. That's how the gold bugs like to work. They like themselves some gold, and they like those high levels. Dees 1,400s, number one with a bullet this week, listeners. About almost 17,000 contracts open there. By the way, open interest very robust this week, up about 7.5% net total for the big. These are, of course, the big COMEX gold options over here on the old Glomex. And again, 1,400s out there in Dees. 16, almost 17,000 going up. The lion's share actually on Monday, 9,000 of those. So a big clip, and a good chunk of that opening, almost half of that opening. So a lot of opening paper on. So I guess that could be some truth to that. The gold bugs who were waiting for it to blow past 1,300, they were loaded up on the 1,300 strike, maybe deciding to roll up, reposition up to that 1,400 strike to get to capture the next big move that they believe is inevitable out there. We talked about this before, Nick, and we had other guests on the show have done this too. You come out there, you talk about gold, and you say anything that isn't super bullish, you hear about it. So yeah, it's an interesting group out there who are super optimistic about the gold getting down. Then things get a little bit more level-headed as we get down to our number 2 strike. We actually have to go back all the way to front month to October there, and to the comparatively more realistic, level-headed October 13 halves. That's where about 9,200 of those traded this week. About a third of them come in on Tuesday. That was the big day out there. And pretty much net unched on the week, so a lot of back and forth on that strike. Maybe some people coming in specking it was going to make 13.5 when it didn't get close there. They closed it out, or it could be a little bit of the other side, people riding out there and then deciding against it once it blew through the 1300. Either way, a lot of back and forth action on that strike there. Then we kind of come off again a little bit to the 1340s, the comparatively reasonable 1340s with about 7,000, about 5,000 of that coming on Tuesday. So one big day there on Tuesday. The rest of the week pretty quiet out there. So 1340s coming in number 2. Then we drop off a little bit again, going back out there actually to Dees, the Dees 1320s with about 7,500, actually close 7,400, so a little bit more coming in with a good chunk of that opening, about 5,000 of that opening. The lion's share coming on Monday, 4,600 of these 1320s in Dees now. So yeah, the paper was kind of interesting across the board. Usually we see, an aggregation in one month, typically the front month when you're talking gold, but this time we saw Dees getting a little bit of love as well. Obviously, gold plays by a little bit of different rules. We have a lot of things driving it. There's Fed meetings in December and other things too, so it makes sense why that paper would be spread out. But still, interesting to see that. Let's get a little bit longer term. We like to peek a little bit farther out, a little bit farther up sometimes when we're talking about the metals. You get out to March of 2018. We see the 13 halves were active this week as well out there as well. About 2,700, pretty much all that closing. So net unched on the week, which is kind of actually pretty much even on the week. So interesting stuff out there. And then you get all the way farther out to Dees of 2018. That's where the Super Bowls were playing to the tune of the Dees 2018 1600s. About 1,000 of those bad boys lighting it up this week, and pretty much 1,000 of those opening. So opening paper on the Dees 2018 1600s. I'll leave it to you to ferret out exactly what they were up to, if they were hitting bids, lifting offers, if they were overwriting, or if they were indeed active. And that's not bullish enough for you listeners. You get 1 year past that, Dees 2019, a small lot, 100 lot of the 1,800 calls were lighting it up this week. So I told you, there's some optimists floating around out there, and they are playing yet again this week. Interesting paper pretty much across the board. Nick, it's been gold's been a fun one to watch. We've said before on the show that if you want to look at a product in the commodity side that really exhibits some interesting skew, some interesting fluctuations, sometimes week to week in the skew versus a thing like the index, which is kind of stable. The gold skew and the metals are a good place to look because they really exhibit a lot of activity. That said, a hot week this week. What did you see out there from a skew, from a vol, and from anything else that caught your eye this week out there in the shiny stuff of gold?
Well, I think if you recall, when we were having our conversation last week, we talked about how the vol was cheap on the downside. It's still cheap on the downside, and we had a discussion as to what we thought were like good trades at the time. And we did discuss buying puts and hedging them. So if you went and looked out at the 25 delta put and bought that Monday morning and then hedged it, you probably were in pretty good shape from that standpoint. So that was an interesting trade then because of where we were in the range, right? We got below 1,300 a couple times this week. We had almost a 2.5, 2.75, 3%, range. So there was some trade there, but you didn't really necessarily see the jumps or the movement and volatility throughout the week. So, and I got to tell you, we're looking at the quick skew, you don't see much of a change in that as well either. So, and you and I talk about how you see the quick skew flip back and forth for this gold, but it must really be in the minds of people that this is the permanent path, and that permanence in quotes, obviously, that permanent path right now is the upside, right? So that's where people don't want to miss. And you mentioned that about the bugs and they're looking and they're not wanting to miss any of that, but it certainly looks like that's where the market is poised. Now, for me, again, we saw this thing trade back down close to 1,300 a few times, and a couple times it dipped below. We had a couple flash crashes, as they call them. I think maybe 2 this week, at least 1 for sure. We had 1 last week, I think, just before our show when we talked about that 2,000 lot, or the 2. What was it? It was so I think it was 2,000 or so that pushed the market generally down. It did it to silver, and then it bounced right back. So not much change in the skew. Still think I like the trade that we talked about last week if we do trade down in the range. And I think, and I was actually surprised given that the market sort of settled down today from the energy standpoint, where RBOB was off from its highs of yesterday. I was a little bit surprised to see gold continue because it had been following going up when that was going up. But, I think the things of note, just the increase in open interest, pretty big numbers in the first 3 contracts even, and across the board, up over 1 million at least in the totals that we're covering. So a pretty good week from that standpoint. And if you're looking at the overall put call ratio, you're going to see it's a majority of calls that are outstanding out there. So still that seems to be the preference up there. But again, nothing significantly different in the quick skew, and really nothing from an intra-week change. We saw really something pretty similar, and I'll plop out this OC one right now. And I'll put this gold, and I'll tweet this one right now, and you can see the curve. Really nothing crazy there. I just think you kind of watch this thing and look at the range. There is definitely some range trading, and I think the change in the gamma is pretty good given that the vol is still pretty low. So if you think we're going to have a pretty good range, and now you can start to establish sort of a range above 1,300 or 1,295 to 1,340 potentially being our range right now. Just looking at it, and we'll take a look at what these high open interest strikes are in this front contract. We could see 1,300 is sort of the big one, but that's got a big call presence. Then 1,350 is the next biggest, and then the biggest downside is 1,250. I don't think we're going to see that necessarily, but I think we're going to bounce around to 1,300. That's where we've been trading, and with this nice 2.5% to 3% range that we saw this week, and we saw it move significantly this week, just back and forth. So I'd keep an eye on things as we get down towards the bottom of that range, and maybe look to scoop up some cheap volatility and hedge it, and see if you can play the gamma game.
Playing the gamma game.
Playing the gamma game. Yeah. One other thing, just of note, as long as we're showing the shiny stuff, I mean, silver really had a decent week. It was up almost 4%, but it held. It seemed to hold from a getting beat up standpoint in comparison to the gold. And when you look out there on the report, you're going to see that there was a lot more activity in the high strikes across the board. Not again, it's relative because there's not that much open interest, but it still seems that there's some silver bullets, Coors Light, right into the beer for the weekend. So some silver bulls still, or bullets. We could call them bullets because they're not quite bulls, because gold is much more expensive. So we'll call them silver bullets, so little bulls. So looks like there's a little bit of upside there from what the market is saying as well.
Bullets, gamma game, you're full of them. You're full of it this week, Mr. Nick. Full of the
full of it is right.
Full of it in many aspects of the term. Let's move on then to what was really lighting it up this week. You guys like to know what were the big winners and losers on the commodity, the futures, options side of the space. And when we do that, we can look at it a bunch of different ways. You guys like to know pretty much who's winning and losing, just from an underlying perspective. So we hit that up for you. Again, you guys can play along. CMEgroup.com/TWIFO, TWIFO. If you want to do these scans, though, you may have to upgrade to the essentials. It takes a couple seconds, just fill out the form. You're good to go, and you could do some of these cool scans here, like seeing what the hot things were for the week. And you kind of gave away the big upside winner, Mr. Nick. This is, of course, the RBOB, the good old RBOB gasoline, up nearly 13% on the week, 12.84% to be precise. Number 2, heating oil, up about 7%. at 0.11%. And then not to be outdone, palladium, number 3, up about 5.4%. Gold, even despite it had a good day, only up about 2.5%. So it's farther down the list. It couldn't compete even with silver, up about almost 4% this week. So if you're holding metals, it was a decent week. If you're holding some RBOB, it was even better. Let's look to the dark side now, to the downside, and the ags once again coming in on the downside here with the oats off nearly 7% on the week. And then we get into our old friend, the fluid milk, off about 3%, class 3 milk to be precise, followed hot on his heels by lean hogs. Lean hogs off 2.7%. They've been kind of rocking and rolling the last few weeks out there. And then number 4 on the downside, the iron ore, 2.63%. And again, you mentioned some other things out there surprising, things like WTI off about 1.25% on the week, depending on where you're looking. So interesting stuff. You guys can play along, do those scans yourself as you head on over to the old Quick Strike Essentials. Mr. Nick, before we get into our volume of questions this week, anything else catching your eye? Any other products or items or things of note before we keep rolling?
I think for me the biggest thing was just the overall, just the lackluster reaction of volatility, and I guess I shouldn't be surprised so much. I mean, the SPOOs didn't do all that much this week. They were down, they were up, and they're up still. They're up right now, but in terms of overall, price location, it's not that much different. So I think I was a little bit surprised with that, but I'm going to stick to what I said and say, maybe there's a possibility of, we'll have to do the post-op after this week and after things get cleared out. And I saw a video where they had the first ship that went under a bridge that was made that part of the canal impassable, whatever. You couldn't pass through it. I don't know what the proper form of that word is, but so I think as the water recedes, I think that's when we might see some volatility. So it'll be interesting. But yeah, nothing really catching my eye. I wanted to talk about gold. I wanted to talk about silver. Silver's really been on a pretty good move here. So I think that's the one that I was really glad to see sort of hang on to its gains, because we had a pretty good gain this week, and then over the last 2 weeks, we started around 17. We traded below 17 or almost to 1680 last week, and then we're up to 7. So it's a pretty good change from a percentage standpoint. So that one was glad to see it there, because it just seems like a product that should trade more than it does, right? If you're really playing the metals game, that seems like a place you could play as well.
Does seem like it. Also places you can play. You can play with us with your questions, because it's time for the Futures Options Feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback, the portion of the show where you guys take the reins, ask us questions a whole bunch of different ways via social media. So at Options on Twitter, StockTwits, Options Insider on Facebook, questions@theoptionsinsider.com, or indeed via our app, or just hit us up if you're listening in the live chat. We got T-Mal here asking us in the live chat. He says, levered put right index. You should put that in your retirement account. I think that's from the last show. I think we were talking about that on Vol Views. Glad to see you sticking around. But that brings up an interesting point, though, actually, Nick, which is kind of interesting. We have all this great, research and data on like writing puts and indexes that replicate these strategies on things like the S&P, hence the put right, what he's talking about. We don't see a lot of that out there. And let's say, a gold put right index, or a gold collar index. Seems like that's that's kind of fertile ground for potentially some research and indeed maybe some products. What do you think? Maybe after the show, me and you go out there and we start creating some commodity options indices. What do you think?
Well, I think the commodity options indices thing would be great because there's a lot of different stuff you can measure, and but we do have our quick skew indice, so more or less, so we can talk about that a little bit more. But yeah, I don't know the nuance of like what the margin requirements are. I think maybe it's different for the S&P and the mini than it is. I heard somebody say that margin on silver, or maybe it was our show even, that margin on silver was really expensive. So maybe that's why there's not so much going on in that vein. But there are a lot of ETF funds that are doing like just crazy stuff all the time, right? So they're trying to mirror everything. So not sure. I don't know how much value is in it, but interesting idea nonetheless.
Yeah, I think it'd be cool to, just people come out and just replicate basic things. Like, what the put right is about as basic as it gets. It's just pretty much writing a monthly at the money put on the S&P. How does that perform? No, we could do something like that on gold, or maybe in the case of gold, maybe writing at the money puts, maybe more into the collars or buying the out the money calls or buying the at the money calls sometimes as well, or do a buy right, do a selling the at the money call. A lot of different flavors you could do. I think that would be an interesting gateway drug for a lot of people who are kind of dipping their toes into the commodities. And it didn't get mean to get taken off on a tangent. That's what I get for reading the chat. But good question nonetheless. Moving on to other questions here. We got JLC. A lot of people asking about the collars we talked about on the show last week in that collar study. JLC says, where can I get the collar study referenced on the show? Well, that was from our friends over at the OIC, the Options Industry Council. You can head on over there to check it out for yourself. It's just optionseducation.org. They have a bunch of collar studies, a lot of them on equity indices. So the one you want to look for is called the Collar Study Across Assets. Excuse me. I have the link here. We'll put it in the show notes. It's a long link. It'd be hard for me to read out here now. But options-based risk management summary, I think is one of the titles of the PDF. So check out that one. Again, optionseducation.org. You'll see the tab there for research. You may have to log in to get some of it, or you can just search for, OIC Collar Study Across Assets, something along those lines. That should also bring it up for you. Again, it's a little dated now. It came out, I think, 2012, but to date, it's really some of the only research of its kind that I've seen, taking exactly what we were talking about before, taking some of these basic strategies and applying them not just to indices, but across the commodity landscape and how do they perform. So if you're interested in that, I definitely encourage you. We do have links to it on our site as well, to the Options Insider. Again, it's been a while. You have to go to our search bar and search for that. You can find it there too. But yeah, it's an interesting one. I definitely think you should check it out if you are so inclined. All right, maybe they'll commission a new one. That'd be kind of nice to have updated numbers on this. I do believe the study, it was 55 months. I think it ranged from about 2008 to 2012, a little bit before, a little after, something in that range. So obviously there's some outliers there with 2008 and things in there, but it's only hard data we have to really look at. Mark T wants to know, so which assets perform the best from a collar perspective? Well, again, not a lot of hard data on this. And I'll let Nick weigh in a second because he can look at it now from a modern now that we have quick skew, maybe you're the guy to do the data research, Nick, because you got the quick skew now. We didn't have this back when we were doing this study was last done. So that might be a useful tool to do this going forward. Here I'm giving you more work, but I think it'd be interesting. That said, looking at the data we have, which is this OIC collar study, again, they studied 55 months from about 2008 to 2012. So doesn't mean it's going to necessarily happen now, but this is the data they have. And they break it down a lot of different ways. They break it down by annualized standard deviation, annualized return, annualized, maximum drawdown. You can look at it a whole bunch of different ways. Obviously, risk adjusted, the collar is going to blow the doors off just holding the underlying. That's just a given. You're using the options to kind of tampen down the volatility, so that's good. But what's surprising is how total return, how competitive it is. And if you're looking at just total return numbers over that period, again, caveat, just over that period, but the two products that were tied were pretty much gold and the Japanese yen, both right about 8.8% annualized return over that 55-month period. So that's a pretty good return. Again, this isn't buying the put and selling the call. So you're giving away some of that upside. But again, it goes back to what we were saying before with the metals. The calls tend to be a little bit juicier. So it makes that strategy a little bit more worth it. Even though you're giving up the upside, you may miss out on some of the big weeks like this week, which could hurt. But on the flip side, you do get more juice over the quiet weeks as well. well. So that tends to make up for some of it. After that, it kind of falls off a little bit. You get to actually the Swiss franc with about 6.63% annualized return. Then the emerging market iShares index and the Barclays 20-year Treasury bond fund were tied after that, both about 5.85%. Then USO, so the U.S. oil fund, they mostly used commodity ETFs here, about 5.2%. Tied also with the Australian dollar, also at about 5.2%. So interesting data. Again, look at this study. If you look at nothing else, just look at this chart. The Exhibit 2, it gives you the whole results for it. And it's informative. It's interesting. Again, past is not always prologue, but there's a dearth of data in this space. So with that said, this is some of the only data we have. Nick, this was obviously a hot topic for a lot of our listeners. Any thoughts here about the assets that perform well, the study itself, or maybe your thoughts now that you're kind of the keeper of the flame here with the quick skew? What you guys going to do about it for coming up down the road?
Well, we're always talking about trying to put, we do have averages over periods of times, and we're showing the chart and that kind of thing. And we have talked about creating a quick skew index as well, taking into account the 30-day and the 60-day and the 90-day. So we'll see how that goes and see what we can work out. Along those lines, we are finally going to release quick skew to the public, more or less. So you'll be able to see it within Quick Strike to a certain extent, and then it will also be available in Quick Fall. So I think people should, if they're interested in that, should come out and take a look at that. And there's a very high probability, or let's call it a high percent. Yeah. Probably going to happen for sure. There's going to be a free version of it out there as well. So you'll be able to see some amount of that data somewhere. So we'll see. Maybe we'll get some ideas from people once they start looking at it and getting more comfortable with it. Or maybe we'll get some people who take it and run with it and, have different ways of showing about it.
We'll need you to add a scan in your scanning section for we'll call it the juicy collar scan, and you can scan for the juiciest collar, however you want to look at it. The cheapest puts, most richest calls, the combo they're in. That might be kind of nice, huh? And then we have that could be kind of the beginnings of doing this going forward. What do you think?
I have a juicy collar within a product report. So I do have that available. So I can post that if people are interested. But you got to ask Mark or ask me via Twitter, and I'll be glad to post it. But basically, it looks at the term structure and tells you where the richest put and where the cheapest richest and cheapest of each of the call and the put. So it tells you where the skew is best suited to maybe do something. And again, it's all relative to where things were in the past, but at least it gives you an indication to where things are. And what I will do is I will tweet our quick skew benchmarks report right now, so you can take a look and see what you think. And this one will give you sort of a nice overview. Let's see, quick skew. I'm going to do this so you can see it too. And this gives you a nice look at where skew has been over periods of time: 1 week, 1 month, 2 month, 3 month, 6 month, 9 month, 12 month. It tells you where it is now, and then it tells you whether the call or put is rich or cheap to all the numbers in general over that period of time. So it's actually a pretty good report. I like it. So I'm gonna put that one out there. You guys can take a look at it as well. But yeah, I think we're close to doing that kind of stuff. And really, scans is the next place that we have to go, because we've kind of gotten a lot of the data out there, but now it's again, you can scan yourself, but to make it easier for users, obviously we should try to do the scans for them so they can at least take a look and see if they can get some ideas from those reports.
Tell me how to. We're going to retweet this. Obviously, you have to tell me how to find those scans for myself on the platform after the show. I kind of want to do that with some of the products. The old quick skew there, which will be kind of interesting. All right, other questions. Other Tom's wants to know: is there a new OIC study coming soon? Not that I know of, but maybe I'll get Mr. Nick to work on it, and who knows? Maybe Nick will come out with his quick skew collar study, Nick, and you'll be the torchbearer for this kind of data going forward. What do you think?
I think I like it. I like the idea a lot. That's pretty good. I'll keep coming with the ideas, because that's how the product has grown. So if you have ideas or reports that you'd like to see, or things that are close in the system, tell us, and we'll go a bit further.
I like it. All about going further here on Twifo here, and we got another question. This is more of a people obviously like the collar stuff, but now this is more of a just a straightforward options kind of question. J. Marello wants to know. I heard that time decay doesn't impact straddles the same way in futures options that it does in stocks. Is that true? And therefore, are straddles better to buy in futures options for this reason? Well, Jay, you don't say where you heard this from. I'd be curious where you heard that from, because I may take some issue with it. But that said, we talked about here before. At the end of the day, products notwithstanding, the Greeks are going to be the Greeks. So your delta, gamma, theta, vega, sometimes rho. Then you get into your second orders and everything else. But we'll stay with the big five for now. Those kind of are the same across assets. They tend to work pretty much the same across assets. You have a certain delta, the underlying is going to equate to that much move in the price. Gamma, same thing. Time decay, same thing. That said, there are some products. We talked about skew before. There are a lot of skew differences in commodity options versus traditional equity and even index options. So skew can sometimes have a bearing on things. But if you're talking about if you go out and just buy a bunch of at-the-money futures option straddles, whole hog, are they going to decay less for some reason than buying it in a let's say, in an Apple option? Let's assume, for the sake of argument, that all the metrics are the same. The vol is the same, the time to maturity, all these things are the same, the cost is the same, and you bought them in a futures option versus an equity option. Is it going to decay less? No. The answer is no. It's going to be the same thing. It's unfortunately, I wish that was the case. I wish I could tell you, hey, go out. There's no decay in futures options. You can buy them. Might be bad for premium sellers. But you don't say where you heard that. I'd be curious where you heard that. But yeah, unfortunately, there is no magic decay bullet in the world of futures options. Mr. Nick, any thoughts on this you want to share with our friend Mr. Marello?
Yeah, I don't know if I can agree with that. I mean, from the standpoint of decay is highest at the money strike, right? So I think it's like you said, a Greek is a Greek. It's going to affect it. Now, potentially, what you could take away from that is if your future is 20 and your strike is 20, you're right on the money. And typically, those are volatility values on each the call and the put. So there's not a lot of intrinsic value. So that decay may not necessarily exist. It's still there, but you're not losing that time. The time value's not quite as meaty. Maybe, I don't know. It's still volatility value. Volatility is maybe going to come off as we move forward, but it might go up to eat into that decay. So I don't know. Looking at the numbers, I think you can't really. I don't know if I can agree with that.
Yeah, it's not. There's no real data I've ever seen to back that up. I wish that was the case. I wish that somehow futures options didn't decay as much. It'd be bad again for premium sellers. It'd be good for the premium buyers out there, which sounds like that's what Jay is. But unfortunately, we want to do that. There we go. We want to bring that music back. A, because we love it, and B, because we're done. Unfortunately, listeners, hard to believe an hour just flies by when we're talking gold and crude and quick skew and your questions about collars and everything else under the sun. Keep those questions coming. We love it. Hit us up throughout the week. We filter the good ones up. If you want to just hit Nick up throughout the week, or us too, you can do that. Add options for us at Quick Strike 1. Leave off the C for cool. And so QUIKSTRIKE1 for Mr. Nick. And you can hit him up throughout the week directly. And he puts out a lot of great reports. You should be keeping an eye on those as well. Throughout the week. We retweet a lot of them too, but follow the man over there and his team, and you can get the data straight from the horse's mouth. I'm guessing, judging by your inquiries, you're going to see a lot more data on collars coming down the pike, which should be kind of interesting. That said, Mr. Nick, I don't want to talk for you, so what do you guys got cooking over there in Quick Strike land?
Yeah, like I said, a couple things, I think, and as much as I know this is a platform to promote the platform, I also feel sometimes I feel strange about doing it, but on the good side, you're going to see quick skew out there, and it's probably going to see a little bit of a free version of quick volatility, which is our historical database. So I think that's a positive coming out in the next. That one is a little longer time frame, but next quarter for sure, quick skew will be out there for people who have subscriptions, and then the free thing we'll see what the timing of that is. specifically. The other good news, I guess, is, we tried it before, and we're going to try it. We tried it before and then pulled it back, and then we're going to try it again. But we are going to have an affordable version, a $50 a month version of Quick Strike that you can get, and that's going to have delayed future updates and volatility changes throughout the day. What we try to do is we had people that looked at certain, kind of the real basic data, but we wanted to make sure that they got pricing updates and that kind of thing. And, there's no historical or anything like that, but we're going to give it a try and see if we can find some interest with the people who need a little bit more than essentials, but don't want to jump up to the professional light or the pro because they can't really afford it, or they're new to trading, or their budget doesn't, or their P&L per month doesn't allow that. But that should be out in the next couple of weeks. I'll let you know on Twitter. But I really like that version. I think it's going to be good introductory level, and see what you think about the product itself.
There you go, listeners. Check it out yourselves. You can kick the tires during the show or after, whenever you're listening to this. CMEgroup.com/TWIFO, TWIFO. A good place to start. And you play with some of the basics there, and you get a feel for it. Maybe you upgrade to the essentials, and you keep the upgrade path going on down the road. Again, if you're into this stuff and you listen to this show, so I'm guessing you are, Nick and his team over there are kind of literally the only game in town. There's a reason why CME uses a lot of their data, because they put out good stuff over there. So if you want to play on the futures options side of the space, easy for me to say, then you owe it to yourselves to at least check it out. CMEgroup.com/TWIFO. Heck, it's free. Doesn't cost you anything, especially if you want to play on that level. And you want to upgrade down the road, go forth and prosper. And again, check out our friends over there at CME while you're at it. They have the Good Institute over there too. All of these questions you're asking about collars and stuff, they may have some answers for you. Head on over there to the CME Institute. Get your options education on in between shows. And of course, Nick and I will join you back again this time next week. Who knows what we're going to talk about next Friday? Every week is a new adventure here on TWIFO. Have a good and safe holiday weekend here in the States. For our listening audience outside the U.S., have a great just Monday off. We'll see you next Friday for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.